good morning, everyone. I think that we can now start the event. So I'd like to handle the floor to Thorsten Beck, the director of Florence School of Banking and Finance, for some introductory remarks. Thorsten, the floor is yours.
Yes, thank you very much and welcome everybody. And my apologies that I cannot be in Buontalenti, where I would like to be, but unfortunately I have to be up the hill for a online call. But I'm still delighted and still would like to take the opportunity to welcome everybody to this event, jointly organized by the Florence School of Banking and Finance and the Jean Monnet Center of Excellence on Sustainable Finance and Law, and of course part of the Climate Week, which is organized by the School for Transnational Governance and in the overall context of the State of the Union, as far as I understand. So, sorry, that's a mouthful. Now, we all know climate change is not just urgent, but it's also becoming more urgent and more relevant. We also know that we cannot just do it with public finance alone. Private finance has to be used as well. But this, of course, also requires some legal and regulatory structures to channel it the right way and to also make sure that it is allocated to the correct purpose. And for that purpose, of course, the European Union has adopted a number of different regulatory strategies to protect the environment, deliver a fairer society, and improve governance. And this handbook this Cambridge Handbook of the EU Sustainable Finance covers a couple of these topics related to the legal and the regulatory framework. And I think it's a great moment to not only present these different chapters, or some of the different chapters, but also to discuss them and kind of move forward what we need as next steps. The Florence School of Banking and Finance is for us green finance, sustainable finance in a broad sense, of course, encompassing also finance for the mitigation of climate change and transition to net zero is one of our core areas. One of our four core areas. We do, of course, as many of you know, training, but increasingly knowledge production and policy dialogue is critically important. And it's exactly in this context of policy dialogue that we co-sponsor and co-organize this event today. So again, my apologies for not being there, and also for having to disconnect in about 30 seconds. But I wish you very fruitful discussions and looking forward to hearing back from my colleagues what you've discussed. Thank you very much, and back to you, Jan. Thanks.
Thank you, Thorsten. My name is Pierre Schlosser. I'm the Deputy Director of the Florence School of Banking and Finance, and also an Assistant Professor of Political Economy at the Schumann Center. It will be my pleasure in a few minutes to chair session 1. But before that, we'll have a brief presentation of the book by the editors. So I'm very pleased to introduce you to Michele Siri and to Matteo Gargantini. So I'm not sure in which order you would like to proceed, but the floor is yours. Very good.
Thank you, Pierre. Good morning, ladies and gentlemen. It's a true honor to be here at the European University Institute, just to introduce our academic work on sustainable finance. As you certainly know, sustainability and sustainable finance with it have been one of the most debated matters among the public and the academic community in recent years. A growing set of laws and supervisory policy are being adopted and implemented to drive private finance toward objectives that support environmental, social, and governance purposes. Market participants have increasingly invested in ESG compliant assets and sold their clients sustainable products. Although the actual ability of such products to foster better climate and or societal conditions was sometimes difficult to ascertain. Scientific research, including in the areas of law and finance, has followed suit with an impressive body of outputs. This book is an attempt to shed light on the complex system of sustainable finance that has resulted from years of legislative frenzies, changing market practices, and academic efforts. This book is neither an enthusiastic supporter nor a skeptical challenger of the virtues of leveraging sustainable financial products, sustainable prudential regulation, or corporate purpose to promote ESG targets. Rather, the book aims to provide a tool to navigate the intricacies of sustainable finance. We hope that with the help of its essays, the readers will then be able to reach their own well-grounded opinion on the merits of this new strand of financial law and regulation from a general point of view. This is part 1 of the book, as well as in its components that involve corporate law, it's part 2, capital markets in part 3, financial stability, part 4, and financial and technological innovation, the role of fintech in sustainable finance. While the authors have expressed their own views on specific aspects of sustainable finance, the book as a whole provides an image of sustainable finance that highlights its opportunities, but at the same time does not overlook its risk, mindful that the road to the hell is paved with good intention. As Tariq Fancy highlighted, sustainable finance is a confusing area of finance that often means different things to different people. And this is therefore important to dispel misunderstandings because we are running out of time. We can no longer afford to answer inconvenient truths with convenient fantasies. This book is largely centered on the legal framework of the European Union. Of course, we represent and acting in a Jean Monnet Center. The reason is straightforward. The bulk of the recent legal developments concerning sustainable finance has occurred in the European Union, partially as a result of the European attempt to become a regulatory superpower. At the same time, we devoted attention also to the US and the United Kingdom. The European Union is in a special position because the fast developing landscape is a particular, a specific characteristic of the European Union legislation. In light of this development, the book has undertaken this research project in the Jean Monnet Center at the University of Genoa and assembled a group of academics, practitioners, whose research focuses on the legal implication of the integration of sustainability in corporate and financial law. However, the group of contributors came from different disciplines, including law, economics, finance, management, and accounting. They have approached the topics from the perspective of how ESG challenges are transforming how we understand the law and regulation of corporate governance and banking and financial markets activities. As a final words, I can say we wish to promote a better understanding of how ESG challenges are transforming financial regulation and supervision and the governance of institutions and firms from a European and comparative perspective. I wish to close with a final words of thanks to my colleagues, Matteo Gargantini, among others, who is co-editor of the book, and to Professor Guido Ferrarini, who inspired our researchers since the beginning. So thanks again for this kind invitation. And if I may, I leave the floor to Matteo Gargantini for some final remarks.
Thank you very much, Michele. Maybe just a few words from my side also. Well, I would like to start by thanking the European University Institute for the hospitality and integrated organization. Well, when you do so little in organizing this kind of events, well, that means that on the other side, there is somebody that is really working hard on that. So let me thank Jan, Trevisan, Leonardo, Gianni, and Pierre for the great job here. Maybe you have just a few words to complement what to follow up on what Michele already said. We are, let's say, on the verge of publishing this book. The first thing I would like to highlight that maybe could be of help also in listening to the individual speeches of the day is that we are talking about a handbook. So our main purpose is actually to explain, while we do not refrain, and our authors, of course, do not refrain from giving their own views. The main purpose of the book is to clarify to the maximum possible extent a body of law that is constantly changing in the European Union, even if it's really relatively young. And it's often very difficult to understand in the first place. I have to confess, I'm not new to financial law. I've been working on that for 25 years now. And when I read some of the European statutes, I still struggle from time to time to understand what they mean, honestly. And when I teach these kind of things, it gets even more difficult to make them clear to the students. So this is the main, maybe the main added value, I think, that the authors of the chapters gave to this book. So to drive readers through the complexity of European sustainable financial law. And also, yeah, this is something, again, in line with what Michele already said. We tend to we asked our contributors to of course express their opinions, but I have to say overall what came back is a picture where all the chapters have a quite of a neutral approach. So you will see that some of the authors are more enthusiasts of EU sustainable finance, some are a bit less, but the overall understanding is that in the first place we should make sure that whatever we're looking for, we get to the result that we want to achieve in the best possible manner, possibly by reducing the compliance costs. That's not something that, again, in the overall picture comes out, meaning that the overall understanding is that we still need, there is still some work to do to have it fixed, meaning that the different pieces of the European sustainable finance law do not always talk to each other very clearly. You have concepts that are sometimes similar but not identical, and then it's very difficult to understand what their meaning is in each pieces of the legislation. Sometimes the organization and the underlying regulatory approach changes. So let me give you some examples. As a financial intermediary, you might have to work on the sustainability preferences of your customer under the MiFID II system. And then there you have a sort of a tripartite classification there of what that means, but it's not very easy to understand how that tripartite classification talk to the disclosure system in the SFDR regulations, on the regulation that applies to market participants, especially when they are selling financial products to their customers. So it's very difficult then for intermediaries to cope with this. We have a chapter in the book on this by Verle Koller that explains these kind of things, but it's not only there. I mean, the differences between the do no significant harm principle and the assessment of the principle of adverse impacts might be also not that easy. Again, we have other chapters on that. So there are many similar problems. Also, the very concept of materiality, the double versus single materiality. We have some pieces of legislation, like just as the SFDR, when it comes to the CSRD, sorry, when it comes to the double materiality, but that's only one part of the picture. So for instance, if you have to look at the material information there, that's one notion. If you have to look at the material information, for instance, under the market abuse regime, that's untouched yet. And then the question is, okay, that's maybe still a single materiality concept. So how do you combine that? And even if you change your point of view and you look at the sort of production, at the supply chain of the data, you see that there, again, the rules applying to the different development stage, when you have them, they are not necessarily in line with each other. So the data providers are not yet in the picture. There is a mandate to the Commission in the newly approved regulation on the ratings to check whether that would be needed to be regulated, but by the moment they are out of scope as such, then you have the external reviewers, for instance, in the green bond system. Then you have further down the chain, you might have the ESG rating providers, the benchmark providers, and then you have the market participants that are using the benchmark and the rating. So the whole chain, again, is subject to rules that do not always talk to each other very, very clear. So this is another point that we think the handbook can be considered, I say, as an added value. This is, I think, what one can take from the reading of the book, and hopefully also from the short presentation today, which is actually the first half of a 2 days event. The second one will be exclusively online, held by the University of Zurich. So in concluding, I would like to thank myself, actually, first time I do it in public, Michele Siri, for organizing this. Here I have to say something similar to what I said for the EUI applies, meaning when I joined the editors group, the whole job was already done when it comes to liaising with the authors and structuring the book. That really simplified my job a lot. And Kern Alexander too, of course, for the great job he did with Michele Siri and in, let's say, coordinating this. So thank you very much again. That's everything from my side. Thank you.
Thank you, Michele. Thank you, Matteo. I also see a great need for such an approach, in the sense that the field, as you say, is extremely complex, and we need also people who can translate this for an audience who is curious about it, but not necessarily an expert in the individual pieces of the agenda. And I'll go back to this also with a view to interacting with the audience in a few seconds. So some background, I'm not the moderator, I'm the backup moderator, which explains a bit also the gender imbalance, which is not very ESG compliant, but there will be, of course, a lot of diverse perspectives brought in later today and in the field, as you know. So just my apologies for that. I wanted very much aware also of the timing that we have, because we don't have so much time, and already presenting a book is a difficult enterprise. Presenting an edited volume is really, really difficult. And when it's an edited handbook, I think it's even a notch further. So we'll require a lot of energy and a lot of discipline. But I wanted first to also check with the audience what profiles we have in the room. So can I just ask, who of you is a lawyer, just by a raise of hand? So that would mean, gentlemen, that the audience is predominantly a non-lawyer based audience. Just flagging this. So that's one. The second one is about the acronyms. So if there is any acronym, there would be plenty that you're not familiar with. Feel free to interrupt. And generally, I think that we will adopt this modus operandi for the next less than an hour, because we stop at 10:35. Rather than waiting towards the end for questions and interventions, comments, feel free to just raise your hand, and we'll make sure that we develop space. Perhaps the presenters will need a few more minutes to finish their thought or their sentence. But I think it's important that we make this dynamic, because it might be that at the end, we arrive at the end of the discussions, comments by Valerio, and there will be 1 minute left. So that would be a bit frustrating. So feel free, really, when you have a burning question or a comment to make, or a clarification question, just step in and raise your hand, and you will be given the floor relatively fast. So I think that this is what I wanted to flag from the start. What I didn't flag is the importance of their contribution now that both Michele and Matteo are changing hat and become authors and no longer editor for a few hours. The piece on information intermediaries has also been published and has been actually received a reward from the ECMI, for its originality and deep insights. I had the pleasure to read it also at the time. I find it really, really impressive in the diversity that it brings of analytical, qualitative also complexity. So I find this really, really an important moment in the context, as we know. The context is very clear to everyone, I believe. Data and information is going to be the sort of fuel to move towards sustainable finance. And there are obstacles on the way in terms of also there really, on the one hand, data gaps, and on the one hand, also data surpluses and inflation. And it's important to keep also, I think, a very important measure in how to process this data and how to make it also available to market participants. So intermediaries are going to be key in all this endeavor. I don't want to be longer than this. I give you the floor, Matteo. Michele.
Okay, well, actually, I will be the one presenting the paper, as you can see from the first slide. But of course, my first point is that this is a joint effort with Michele Siri. Just for the sake of simplicity, I will be the one talking. Actually, well, I find it very useful that you made this small survey because, to be honest, yeah, I was not expecting this kind of audience. So I will also try to make it simple and to avoid this alphabet soup, which we will go back to with all these acronyms. No, of course, I'm looking at you because I will stick them to your recommendations. That's the point. So I will try to, again, not to go into the alphabet soup, but again, if something is not clear, you just let me know, and maybe I will focus only on some of the slides just to be clear and not to go into the technicalities that are not so important. So our chapter deals with essentially 2 points, two service providers, let's call them like that. So the providers of ESG ratings, sustainability ratings, and ESG benchmarks. So ESG ratings are essentially opinions concerning the well, let's say the quality of the rated entities when it comes to their sustainability profile. So their ability to cope with the ESG, so the environmental, social, and governance profile. Well, for the time being, these entities are not regulated entities in the European Union. So up to date, they have been able to do their job without any specific constraints. But recently, the European institutions have approved a regulation, which is not yet published in the official journal, but we have the final text. So we can say something about that today, and that's also one of the purposes of our chapter. When it comes to ESG benchmarks, instead, well, benchmarks are essentially, technically, they are just figures, but what is more important to us is that these figures are based on a basket of companies that are selected because they comply with some requirements that the benchmark defines. So, for instance, if you are an issuer that sticks to certain requirements when it comes to the greenhouse gases emission, then you may or may not fit within the benchmarks. Well, if you do fit, that's great for you because all the investors that are really relying on the benchmarks when it comes to selecting their portfolio, they will spot you and they will invest in your shares or bonds. That's the good thing of qualifying for a benchmark. So you see how sustainability ratings and benchmarks can be an important driver for the investment decisions by large market participants, especially. So our questions, our research questions are, these were judged innovative in the assessment of the ECME CEPS prize. But this is quite surprising, and it says a lot about the publications and maybe in the area, because what we did is essentially to open our handbook of regulation and see, okay, what are the main questions there, and just go back to those questions. So it's really basic stuff, but that's something that maybe sometimes people that deal with this kind of stuff tend to overlook because it's considered too basics. So we just went back to the basics. So our questions are very simple. First, why do we need to regulate this kind of stuff? Why do we need to have rules on ESG ratings and ESG benchmarks in the first place? Well, the standard answer is that, well, normally you need some form of regulation when you have market failures, meaning suboptimalities that are not tackled sufficiently by the market alone. And then, of course, the second question is, okay, then if we are in such a condition, are these market failures, so these suboptimalities, similar to those that justify regulation in other more traditional areas of financial regulation, such as credit ratings, or are they different? First, that's more of the positive analysis. And the normative analysis is, okay, in the light of this kind of background, how should the new rules on sustainable finance in these two areas look like? So should the rules on sustainable ratings and benchmarks look like the old ones, or should they be different? And if different, how and why? So this is essentially what our chapter tries to answer. And in doing that, we take this analytical framework. So just like, well, credit rating agencies, so the more traditional rating agencies that are actually assessing the credit worthiness, so the default risk of issuers and financial instruments, just like these more traditional entities developed because they answered some needs, they met some needs out of the market. The same applies to these new entities. So essentially, the traditional problem behind credit rating agencies, for instance, I will use them as an example, is that, well, as an investor, you don't know always too much about the company you are investing into. And if you have to do the job on your own, that's very expensive. But if you don't do the job, again, you will be subject to a problem of asymmetric information that leads typically to adverse selection. If I don't know too much of what I am buying, that applies to any market. Well, I'm not willing to pay too high a price because maybe I'm buying a lemon, so I will discount the risk that I'm buying a lemon, and then you will be squeezing out the good market participants, those that need a higher price because quality has a cost. That's why credit rating agencies and other similar institutions developed in the first place. That applies also to our topics, so the ESG ratings and ESG benchmarks. But just like it happens with the traditional institutions, unfortunately, these institutions that are born to cope with a kind of market failure, they're subject to their own market failure. So, well, how can you trust that rating agencies get it right? Maybe they are in a conflict of interest. Maybe they are getting paid by the rated entity. So, well, same problem here with the ESG ratings. So that's our analytical framework. We are not only looking at the market failures that the ESG ratings try to tackle, but also to the market failures that affect the provision of ESG ratings themselves. And we apply this kind of analysis to the two prongs of the materiality. So meaning the material information is the information that investors and now increasingly stakeholders in general would consider as relevant for their decisions. And this is, well, the traditional view, the so-called outside-in perspective is, well, as an investor, I might want to know how much the entity I'm investing in is exposed to the sustainability risks, because if something goes wrong, maybe a major issue concerning a pollution problem, well, that's going to affect the reputation for sure, maybe the liability of the company I'm investing in, so that's an interest I have. That's, well, developing, but that's why that's more of a way to make the traditional assessment of risk more sophisticated, if you like, to include in the traditional formula, to factor in the traditional formulas the sustainability elements. And then you have the inside-out perspective, also information that is relating to impact that you can have as a business on the outside world from the point of view of the environment, the social concern like minor or child labor, and on the governance, they can also play a role regardless of the impact that this can have back to the profitability of the company. So that's a bit of a new approach and requires some new thoughts. So this is the kind of things that we are looking at. Again, I'm gonna skip some slides because we don't really have too much time, but if you wanna, in a nutshell.
Can I just ask if there was any clarification question at this stage?
Everything is clear. Okay.
Fantastic.
Oh, please.
Yeah, thank you very much. It is very interesting. And my question is related to the one kind of market failure. So the market failure, what kind of market failure? You explained to some extent. And but why such market failure? Why market failure occurred? So I guess some reasons there. So for instance, the lack of information and the decision-making capacity is not enough, or if enough capacity the financial people has, but not enough time to, for instance, such kind of reason. So I think this is the first step to discuss about this. So can you explain a little bit more about what kind of market failure and why such market failure occurs? So at that time, we need to think about the mitigations.
Sure.
Thank you for this. I'll give the floor to Matteo in a second to briefly explain what on the market failure aspect, but then we can also elaborate more towards the end. Was there any other intervention at this stage? Okay, back to you.
Okay, well, thank you very much. This is a very good question, and I really like it because I think, well, regardless of the technicalities that we can really leave aside, maybe it's really more important to get into this kind of thing. So let me talk about the that's not the only one, but it's the most important market failure we are dealing with in this kind of things, which is, again, asymmetric information. Now, I told you a little bit about the dynamic, and your question is, okay, why do we have it, and why aren't the investors on the one side and the providers of financial products on the other side coping with it? That's one of the typical features of asymmetric information, which is one of the most peculiar kind of market failures, because if you think about it, and that's why your question is very good, I think, both parties have an interest in solving it. That's not the case with other kind of market failures. Another one that is often mentioned in this sector is, well, negative externalities. Pollution means that I am offloading some costs on other people, just like the other stakeholders, and I don't pay any price for that. Well, there I have an interest in doing that. But when it comes to information asymmetry, actually, as an investor, I would like to have as much information as I can so that I know what I'm buying, including from the point of view of the sustainability of the investment that I'm making. And on the other side, the supplier, so the entity that is selling me the financial product, they also have an interest in letting me know as much information as they can, because if they are able to convince me that they are selling me something that is sustainable, well, I will be willing to pay a higher price for that if I care for the sustainability. So why is this not happening, which is, again, the point of your question? Well, first, to do that, you need, as you say, to spend quite some time as an investor to analyze the information that you need. In part, ESG rating providers are solving this kind of problem. They do the job once and for all for everybody. And that's efficient, if you like, from the point of view of the economies of scale, because you have quite some large economies of scale. So it makes sense to have somebody that does the job for everybody, and it gives you a synthetic indicator that is very easy to use. But even before that, what is very difficult is to, as a supplier of the financial products, what is very difficult is to convince the buyer that you are sharing reliable information. How do you trust the seller that is giving you reliable information? In other markets, you can easily solve that. Think about the economic role of guarantees. When you buy your phone at a shop, they will tell you, well, this is a great phone and it's going to work. Even if I don't switch it on now at the shop, you can be confident enough that it will work because they give you a guarantee. So I take on a credible commitment that the risks of the malfunctioning stay with me, the seller. You cannot do that very easily in a financial product because the very essence of financial product is that you buy risk for the return. That's one problem why, for instance, private ordering solutions do not work. There are others. So that's why in this specific field, it's very difficult to tackle asymmetric information problem with traditional systems, and you might need some rules there. Okay. Perfect. So maybe just in a nutshell, because I'm already almost out of time, if you want to grasp in a nutshell the kind of problems that make the regulatory failures, the market failures, sorry, I didn't even talk yet about regulatory failures, but the market failures in the field of sustainable finance, in particular when it comes to the assessments of ESG ratings, particularly tricky, is that, well, we start here from a quote from William Deming. He was an expert in measuring quality for firms. And he said, well, I've been spending my life in measuring quality, but actually the most important things cannot be measured. I mean, can you measure love? That's something that you cannot do. This is not precisely the case when it comes to ESG concerns, but maybe what is true in our field is that you cannot really compare the most important things. You can measure how much carbon dioxide tons you are releasing in the atmosphere. That's a critical factor for the calculation of the environmental pillar in the ESG ratings. But what is difficult is to understand in a synthetic ESG rating that gives just a figure. Okay, how much should I weight, for instance, in ESG, means that I am sharing a single figure, calculating the impact of the firm, both for the carbon dioxide tons and, for instance, the impact on child labor. How do I weight them? That's one of the problems that arise from ESG ratings, the subjectivity. So just to share some of the problems. First, if you check in the literature, you see that, well, when you measure the reliability, you just tell me when I'm out of time, of course, Pierre, please. But if you measure the reliability of the traditional credit ratings, so the old ones that you are more familiar with, see that normally the correlation is extremely high, around 96–97%. So they are really consistent with each other. So Moody's, Fitch, and Standard & Poor's will give some similar outcome. If you do that with the ESG ratings, you will see a higher level of dispersion. So the same entity can get very high ratings from one agent, from one provider, and very different ratings from the other one. Now, it might be that they are measuring different things. I have to say, Michele and I are more lenient with them, and we say, well, this could be actually an explanation, but we are a bit of a minority in the literature. If you look at the literature, most of them will say, no, actually, if you analyze more in depth, it turns out that they are just weak in their methodology. So they are giving different results, even if they're looking at the same thing. So maybe they are subject to their own failures, again, even if they are trying to solve other failures. Again, the methodologies are filled with discretionary assessment. How do you weight the environmental element, for instance, with the social one? Think about the example I gave before. This is something the new regulation is now dealing with. I don't know if I have the time to go, actually I would not have the time to say too much about that, but just to tell you that one of the things that the new regulation is doing is to say, well, as opposed to what is very common nowadays, as a matter of principle, ESG rating agencies will not be allowed anymore to give one synthetic indicator for the E, S, and G altogether. And if they do, they will have to split that too. So they will have to say how much E, how much S, and how much G they have in the ESG synthetic indicator, which is a good way, I think, to address this kind of problems. Also, it's very difficult to understand for investors what the ESG rating agencies are measuring. I have to say, I checked some methodologies of the most famous one. They are very clear on that. So in the first line of the methodologies, they are saying what they're measuring, but apparently investors are not really receptive. I don't know why, honestly, on this kind of information. Well, I have my ideas, but maybe for the discussion, why they are not so receptive. Some ESG rating agencies are measuring the first approach that I told you before. So how much the financial risk, the traditional one of a company, is influenced by the reputational risk or the liability risk coming from ESG related dynamics. And some others are just measuring the impact. So how bad or how good is the company for the environment or for the society? These are very different things. And sometimes investors, apparently, especially those who care more about the impact as such, tend to mix one for the other. Again, another rule in the new regulation by the European Union says, okay, you have to really flag even more clearly what kind of rating you are releasing. And finally, some traditional issues concerning credit rating agencies are also common with ESG ratings. So whom are they paid from? Is it the issuers paying them? So maybe there is a conflict of interest because, well, it's more convenient to get to give higher ratings to be paid more. And the market structure that's not yet as concentrated as the credit rating market, where you have essentially the 3 plus 1 or 2 big participants, but it's getting there. So according to the European Securities and Markets Authority, there is an increasing concentration. So these are also matters. Again, how do you tackle this? Having some concentration, well, of course, it's not very good, as in any market. Having the risk of an oligopolistic system is not good. But in this specific case, well, if I have some market power, maybe I'm not really captured by my clients because, okay, well, I might be more independent in giving my assessment because, well, there is not anywhere else you can go as an issuer beside my large competitors. So maybe that's good. Again, a double-edged sword that we talk a little bit about. Again, I think I'm already out of time. So maybe what I can do is just to skip to the conclusions, just to give you a little bit of a flavor of where we are heading to. Oh, sorry, that was too much. Okay, first, how do we answer our first question? One minute on this. We notice that the market failures are worse in the field of ESG. Well, this is not, say, rocket science, nor is it entirely new. But we also come to the conclusion that that market failures are worse in the ESG world compared to the traditional one. Just one point to mention: it's easier to it's relatively easier to use private remedies, such as the liability in case of a malfunctioning, in the traditional world of finance as opposed to the sustainability world. That doesn't mean, in our opinion, that you need to have a heavier set of rules. Even just a lighter touch approach, but which is, in our opinion, devised in a careful way, could be more helpful than a fully fledged command and control system, the traditional way to regulate. In this sense, our assessment of the developments in the European Union is a bit mixed. For instance, well, I didn't talk about benchmarks, but we like that kind of approach a lot. We think that the ESG rating regulation is a good one, but we would have preferred, again, a lighter touch approach. Our main concern is that this authorization system can paradoxically cast some appearance or of a higher reliability than is the case. We don't have strong methodologies in the ESG world as we have them for the traditional assessment of the default risk. So if we put the stamp of the supervision like authorized, maybe we can feed some excessive reliance from the side of the market, which is not exactly good in our opinion, considering, again, the fact that it's very difficult to understand how reliable ESG ratings are at the moment. And this in spite of the fact that some market participants, especially the largest one, and then I am done, we talked to some large investors. I cannot make names, but I said, well, 5-6 years ago, we were really using a lot these kind of ratings. Now we realize that maybe it's better if we develop our proprietary system to analyze, because we are not yet 100% convinced that all of them will give us what we need. It doesn't mean that it's wrong. Maybe it's just not exactly what we need. So we prefer now to use them still, but to compare them with our own analysis, which is excellent from a regulatory point of view. If you actually put the label of the authorization, maybe you are going a little bit against this kind of attitude, and so maybe you might have some unintended consequences. So of course, this remains to be seen, but we would have preferred other systems. We have other examples out there to look at. For instance, the financial analysts, those saying the famous report buy, hold, and sell, those are not authorized, which is great because you don't read them as something that has any label, even implicit from the regulators. But they are just subject to reporting. They need to explain whether they are in a conflict of interest, what are their methodology, and that is also great that you have a calibration. If these people are selling themselves as experts, then the regulatory framework is tighter. If you're just telling your opinion and say, well, I don't know too much, well, that's subject to some rules, but way lighter. And this would also facilitate, in our opinion, a little bit the market regulation overall. Again, not too bad, but maybe, well, academics are never happy, otherwise they couldn't write. They always have to find something that is wrong. I've never seen a paper saying everything is excellent, otherwise it would be pointless, but this is a little bit our take in spite of that. Sorry for speaking a bit too much, but thank you. Thank you. I'm open to any questions, of course.
Thank you very much, Matteo. In a few seconds, I'll give the floor to Valerio, who is the discussant of your chapter. You mentioned several times credit rating agencies. That might be a point of discussion going forward. There are indeed links, there are comparisons to be made, there are limits to the comparison. I think that the context is also that a lot of ESG ratings are actually also provided by now by credit rating agencies themselves. But I mean, the sort of elevator pitch is essentially that I think in the current context, CRAs, credit rating agencies, are supervised, regulated, provide ratings that are highly correlated, based mostly on quantitative indicators. ESG ratings on the other side are largely uncorrelated. Not mostly, but very intransparent, are not regulated, are not supervised, and rely to a great extent also on qualitative indicators, which is part of the problem, and that Valerio may come back to. So the floor is yours, Valerio. Valerio Novembre is research fellow at the Florence School of Banking and Finance, and before that was at ESMA, which has been mentioned already, and which will be the authority supervising ESG ratings. ESG rating agencies, or whatever is termed in the exact regulation. Valerio, the floor is yours.
Thank you, Pierre. So I'll try to be quick in the interest of time, but first of all, let me congratulate with the authors for what I really find a very clear, comprehensive, and systematic, as well as comparative, I would say, analysis of the ESG ratings, market and regulation, which I think, you know, it's a lot of words, because really they try to put in a few pages really many things. And within a handbook that, by the way, as someone said before me, that, you know, it's comprehensive, but at the same time is also very interdisciplinary, which is, you know, not always easy to find. So really congratulations. And it's not because I'm here today, really find. And not because they're also friends, but I can disclaim that. As an economist, I must say the first thing that I really liked was the fact that they started with the market failure analysis, regulatory failure analysis. You know, it's a little bit the way I was taught in school books, really, to look at regulation. And it's if you want, it's can be a bit naive sometimes, because you are comparing with a non-existent world of perfect information and efficiency that we know, you know, economists have been arguing for, but doesn't exist in life. But at the same time, it really provides you with a framework and helps you in understanding where we are. And also the analysis of the market structure as well in a legal paper is very rare to find, which I found very interesting. And finally, and I think it's the key point of the paper, is the comparison with other information intermediaries, right? So putting sustainability ESG rating agencies in a context, in a market, and in comparison with other players that somewhat could resemble their characteristics, right? Such as CRAs, of course, but also benchmark providers, and we say also financial analysts. And finally, also really liked the emphasis on avoiding regulatory licenses, the importance of that, either they are explicit but also implicit, as Matteo just said. This is very important. These are all, in my view, very key points that they have been able to raise in so few pages, so it's really congratulations. I must say that I also agree, I concur with the idea that EU regulation in this area has embraced a so-called full menu, right? So the full menu is, you know, the regulation is out of press now, not even. So we are talking about something it's very fresh, but basically it copies and pastes a little bit the credit rating agency approach. So you have transparency rules, for example, on information sources. You have conduct rules, for example, on methodologies that need to be rigorous, systematic, objective, and so on. And you have authorization plus supervision. So not just a registration, but really a full set of authorization supervision for, I don't know, the same as you have for a bank, for example. So this is really the full menu. The regulators came with the entire toolkit they had. With, of course, what you said, the risk of providing a quality label and possibly an implicit regulatory license is a bit more complicated, and somewhat to reduce the incentive for analysts and investors to use their own analysis, which is, you know, something to be careful. And finally, I support the conclusion where the paper makes a reference to the role of self-regulation that could have had at least a self-regulatory system, which has not been tested in this area, together with the comply and explain approach. So a lot of agreement. So well, at the same time, I'm here as a discussant, so I need by default to fulfill my role. And so I will provide three small suggestions that could be used maybe for follow-up work or in the refinements if you still need to send it to send it to the press somehow. But I understand you are in the last stages. And I must also caveat that some of these points are already here and there in the paper, but could be probably better developed. So the first point I have in mind is that on top of benchmark administrators and CRAs, as information intermediary, I think it would be worth making comparison with another information intermediary, which is proxy advisors. It is mentioned in the paper, but indeed it's not further developed. I know that it's probably also an element of space, but I find personally that proxy advisors are even closer probably to credit to ESG rating agencies that they may look, probably even more in my view than credit rating agencies. And so the reason in this area, I think it's important to make a comparison because the EU regulation, the EU system, let's say, has put in place a mix of self-regulation, self-monitoring, and a few hard principle-based rules in the law, with namely in the shareholder rights directive. So in a way, this is an area where the EU legislator has been, I think, somewhat, I don't want to say advanced because that would give a positive connotation, but I think it has been certainly trying to make a balance that you can hardly find in other areas of the law, that is between self-regulation and hard regulation in the same area. And I think it would be useful to investigate if an approach of this kind could have produced an effective outcome in this area that we are examining, while imposing, of course, much less cost and lower barriers to entry in the ESG rating industry. So, of course, one can say I buoi sono scappati dalla stalla in Italian. So, you know, unfortunately, fortunately, I don't know, this regulation has just been approved, so it may be a post-mortem assessment, but nonetheless, I think it's useful from an analytical perspective to look at this. Second suggestion, and I will speed up a little bit, and Matteo, you mentioned this point briefly, would be to provide a bit more background on the quality of ESG data, and in particular, the observed low level of correlation and the reasons behind that. I know that, again, this is, I mean, it's easy to say because it's also difficult to do, but, and I also noted a little bit what you said, right? There have been a little bit lenient. You said, okay, it's not such a bad problem. It's okay. But at the same time, I mean, cognizant also of the presentation, I mean, Michele and I yesterday, we were listening to some fresh data in this area published by Cattolica University. And indeed, you can see that these correlations not only are low, which may be okay, but indeed the issue is why they are low. And scoping and assumptions are not so explanatory. And you say that a little bit in the paper, it's more really about the methodologies. We saw yesterday that it's really even the CO2 emissions correlation between one rating provider and the another is only 0.3, if I'm not mistaken. And this is honestly
so it is more likely that they are uncorrelated.
So the aggregation reduces the correlation problem rather than else. So frankly, I think here, I'm sorry, I would be a bit more tough because, but although I'm a fan of the markets finding their own way alone, but at the same time, we need to be clear about what are the different. And then third point, so that I can give back you the floor, Pierre, I would like to really say a few words about the market failure analysis. I also had this sort of understanding from the paper that you support the idea that the new world, as the paper calls it, so the ESG world, may not necessarily be affected by more market failures. No, sorry, you argue the opposite, but I argue, sorry, that the new world may be affected by more market failures than the old one.
Yeah, this is also our take.
So then
maybe
I was discussing with Michele yesterday because
we should write it.
I think this, when I read it, I must say I was a bit into minds. So I was not clear at the end of the day.
Yeah, okay.
For me, what I would certainly agree with you that market prices better aggregate information in the old world because it's easier, of course. I mean, it's you have quantitative information. I also agree with the role of private enforcement that is even more problematic in the area of ESG. That is true because it's more complicated. Private enforcement means, you know, bringing into the court, it's more complicated because of this qualitative information again. And finally, I also agree that the agency problem may be more intense in the area of sustainability because the ESG knowledge is not yet so spread across the investment chain, right? So these are, I all agree. And so if this is, and on this I follow you completely. However, where I would maybe, it's a couple of suggestions. In a way, again, they may be already in the paper, but at least to me, it was not fully clear. The first one is that the partly oligopolistic structure of the market that is already there, and there is a tendency towards further concentration, in my view, is an argument against much regulation, because regulation is also a barrier to entry. When you put a full menu of rules, in a way, you are creating a further barrier to entry in a market. And to me, this is a big caveat, and I would somehow recognize this point. And the second one is that, it's mentioned again, so the paper is really good, but the ESG ratings are paid by investors. Mainly, not always, often also by issuers. But the issue is, if they are paid mainly by investors, you have much less issues in terms of conflicts of interest than you would normally have when the issuer pays, right? Yep. And so this was the case for credit rating agencies in the 30s, I think, Pierre, correct? You know, in the very old world, pre-war in the US, this was the business model for credit rating agencies too. It was the investor paying. But if conflicts of interest are a bit less, then I think, again, this would push a little bit more our pendulum in the direction of a bit less intrusive regulation. So, you know, all these points are really more suggestion for further investigation to enrich part of the paper, maybe this or the next one. But overall, I really think the paper, in my view, is so comprehensive that my role as a discussant was, I think, really challenging. But I'll stop here and I will be happy to discuss further points. Thank you.
If I may just one word, we take all your points for a new version of this paper. Matteo, please.
Yes, we'll just make sure. Let me look at the watch again. So we have exactly 5 minutes left. Is there a question from the floor? Kenneth? Yes, that's 1, 2, and 3. Okay, we'll take those 3 questions. And then we'll make sure that you get a chance also very briefly, perhaps, to respond to Valeria's very good points. There is a microphone well here. Are you taking a so there's a question from Kenneth. And then we'll go here in front and then back to the second row. Just be brief, please, in your questions. Thanks.
Yeah, thanks. I'm just wondering in terms of market failure, it seems to me that you're talking about the market failure for the market for sustainable finance in a way. So my question is the other way around. How can sustainable finance address market failure as opposed to the failure of the market for sustainable finance? Because we kind of created a market and then we're pursuing that market, whereas the purpose can also be to address market failure, the traditional way. Yeah.
Hi, my name is Peter Sweetman. My question is, when you think about comparing credit rating agencies with ESG rating agencies, in credit, you have data points where you can actually measure default. So you know with certainty a bankrupt company's sort of default, and therefore that gives you a basis upon which you can review the ratings agencies' judgments themselves. What are the equivalents in ESG? Is it litigation? What do you count to see kind of like as a way of backtesting quality?
Hi, good morning. Edward from EIB from the European Investment Bank. Quick question, just taking a step back from the details, trying to get a sense. I mean, at the moment, we're seeing corporates with high ESG not really getting a lower cost of capital. That was certainly the case in a low interest rate environment. Curious if you've got any view on now as we're moving into a high interest rate environment, if that's changing. But I'm just trying to get a sense, are you arguing that if only we could solve this asymmetric information problem, then we would see that? Or are you still kind of, is the jury still out whether there's actually a kind of premium out there in the market for all of this?
Okay, thank you very much. Michele, Matteo, 3 minutes, it's kind of a challenge.
But I will be very big. Actually, to some extent correlated. So maybe if I got them properly, I will try to answer them together. Actually, the answer to both questions is, in my opinion, connected to like a big bet that is underlying this overall hype also on sustainable finance, meaning that to some extent we are trusting the fact that if we take some regulatory measures in that field, we might tackle market failures that address the broader market as a whole, meaning, I don't know, the carbon dioxide or other kind of pollution or child labor. These will qualify as negative externalities. So I guess these were the big market failures that we were referring to. So the question is, okay, how can we tackle them? And this also brings me maybe to the third question. Okay, is the system after these rules that we are putting in place reacting in a way that you are actually making the cost of capital cheaper for those who are addressing those kind of market failures, or is it not really reacting on that? The jury is still out. I agree with, I would concur with that kind of assessment, because well, at the end of the day, a large portion of what we are talking about in the handbook, and this is not just about our chapter, this would be more about the whole book. So here maybe I'm answering more as an editor. Is whether the investment preferences of the investors will actually push towards this direction. Because at the end of the day, if you care about return and you are happy as an investor, as long as you can offload as well cost as you can to the environment, then we're actually, well, it will work the other way around. One can actually, there are funds that are specializing in investing in firms that are very low in the ESG, because they say, well, great that they are, I mean, I'm not paying for the cost that I should be paying for, so great, I will have higher returns. Actually, one answer to this can be, and then I really close, is that large investors might be more inclined in investing in good quality ESG products because they are more prone to systemic risk. So if something bad happens, for instance, when it comes to the climate risk at the global level, large investors that are very much diversified and invest like on everywhere, they are going to suffer from that. So they have an interest in that. I don't know if it's sufficient, but at least maybe that's where we have to look at it. Again, I'm not the one inventing this, but there are scholars saying that, and I tend to agree with this. So again, the jury's out, but maybe this is where we have to look at to answer the question. The second one, very quickly, I forgot it. So it was about
on the metric.
On the metric, yes. Well, that's absolutely correct, and I think it's a question that is underlying not only our topic, but again, how we deal with this kind of things in general. Again, when you look at ESG factors or criteria and then pillars, I mean, all the assessment, well, it's very difficult to understand what you should look at in the first place. I mean, in a traditional world, you look at, again, at the default risk, and that's it. You might have different ways to calculate it, but that's what you're looking at. Here, it's even difficult to understand what we're looking at in the first place. And that's not only a problem with the methodology, but I think in a broader sense, think about the role of market prices in the, well, again, this is more for economists, but for the fraud on the market theory or the efficient capital market hypothesis, where those are relying on the fact that as an investor, I care about the actual value of the future discounted cash flow corrected for the risk. We have always learned that this is how prices tend to reflect. But if you have impact investors that do not really care about this and they have in their own assessment just the pure impact, well, how do you assess the impact on the prices in the first place of this kind of assessment, which also goes in parallel with the methodology that you have to apply? So I don't have an answer to them. Maybe I'm just repeating your question. Sorry for that, but which is always a way to dodge difficult topics. But this is the only thing I can think of actually after your comment. Thank you.
Thank you very much. The session is coming to a close. We have a 10 minutes break, and then we'll be back for session 2 on ESG and banking regulation. Thank you very much to all the panelists.
45 minutes. We are slightly behind time, so apologies for this, but I think that in the interest of time, we can immediately start.
Okay, thank you. Let's start with our second session. I give the floor to David Ramos Munoz, professor at the Carlos III de Madrid and also at the University of Bologna, a fellow colleague at the European Banking Institute. He will present his chapter in the book regarding the integration of climate risk in the banking regulation. David, you have the floor, and then we will discuss your chapter with Agnieszka Smolenska from the European University Institute and the Polish Academy of Science. Welcome, also Agnieszka.
Thank you very much, Michele. Thank you very much, Matteo, for this opportunity. If I had been able to just frame the title of the chapter, I might have said integrating climate risk in bank regulation, a work in progress, because this is probably closer to the truth. The process of drafting this chapter was the closest I've been to trying to hit a moving target, but a target moving at extreme speed, because all the events were changing at the same time that I was trying to somehow find some thread to pull on and find a way on this. So the structure of the chapter to a certain extent tries to reflect not the structure of a already established framework for assimilating climate risk into bank regulation, but the attempts that are being made to somehow overcome the scientific obstacles as well as the policy obstacles. I think that's the more accurate description of what that explains the chapter structure. That's why the chapter starts with an initial conceptual section on what do we talk when we talk about climate risk, what are the global initiatives, what is the structure in terms of bank regulation that is susceptible of assimilating climate risk, and then trying to go through the different pillars, not in the order in which they are, for example, present in the Basel framework, but in the order in which somehow reinforces the narrative of the policy difficulties of integrating climate risk. We will talk about this in just a second. After these sections that cover the different pillars, the different attempts in the different pillars to assimilate climate risk into bank regulation, then there is one final, more conceptual section that tries to deal with the, or tries to make sense of why we have the structure that we currently have, where the efforts may evolve in the future, and what could look like ideal, or at least better approach to assimilating climate risk into bank regulation. So this is in what regards the general structure of the chapter. First, more descriptive section on climate risk, then the description of the global efforts and the description of the different pillars, then a sequence with pillar 1, pillar 3, and pillar 2, and then a final conceptual section. Now, if we start with the initial section, I mean, most of these will be known to the audience, but the classification of climate-related risk and the approach to climate-related risks comes from the Financial Stability Board Task Force on Climate-Related Financial Disclosures. Those were the ones that first approached the issue, and to a large extent, they're approaching classifying the different risks and how to deal with them in a banking regulation or prudential regulation context still follows this. They classify the risk into physical and transition risks, and then they classify the physical risk into acute and chronic risk, and then they classify transition risk into different categories having to do with legal and policy risk, technology risk, market-related risk, and reputation risks. Now, what is important to understand is that the task force also, since the beginning, and this has been an approach that has been followed afterwards, they do not try to present climate risk as a sort of separate category that has to be dealt with independently. What they advocate is that these risks have to be integrated into the traditional categories of risks that are dealt with within the prudential framework, namely credit risk, market risk, operational risk, liquidity of funding risks, and potentially, these blurry reputational risk, so to speak. Now, something interesting about climate-related risks, and I try to come ahead of this right from the outset, is that even though methodologically speaking, it makes sense to try to translate the logic of climate and climate risk into a logic more akin to that of bank regulation, because this is the way to provide a seamless assimilation. Sometimes climate-related risks are a little bit unruly. There are processes of self-reinforcing loops. For example, you may have physical risks interacting with transition risks. You may have a risk that impacts liquidity or operations, and that eventually result in credit risk. And you also have the big question mark of litigation risk. Litigation risk is often dealt with as a sort of separate category. But one of the difficulties of trying to address this under this approach is that often litigation risk goes way beyond the individual case that is litigated or decided upon. So the way that a risk manager might traditionally deal with this is to estimate, for example, the damages claim, the amount of the damages claim, and then somehow provision for this or try to estimate it as part of the risk. But very often litigation risk implies changes that reverberate far beyond the individual case and that result in changes in policy that can be affecting a whole sector. Or since litigation and court cases work by analogy, they can be extrapolated to very different cases. So all these elements caution against relatively compartmentalized view of climate-related risks. So that this is perhaps one of the main messages. A second message of this initial section is that although the global efforts at the level of the United Nations, at the level of the FSB, etc., are described in detail, or at least are laid out on the table, the European Union finds itself in a tricky position because to a certain extent it tries to be compliant with the global effort. It tries to follow the FSB, tries to follow the net for the greening of the financial system. Sometimes it even refers to global efforts like those of the Basel Committee to say that this is what the European Union will follow. And at the same time, it finds itself being the more ambitious partner in policy terms, and sometimes having to go ahead with its own approach to assimilating climate-related risks into bank regulation. That is quite possibly the case with Pillar 3 and Pillar 2 measures, for example, where the European Union has been ahead of the global effort. Now, proceeding with the subsequent sections that have to do with the different pillars, one thing that may be striking for someone looking at how climate risk has been dealt with the different pillars is that the relative importance in normative terms and in policy terms amongst the three pillars is greater perhaps for Pillar 1. And yet Pillar 1 has been the pillar that has been most timidly approached when it comes to assimilating climate-related risks. Efforts are much more ahead in Pillar 3 and Pillar 2, but not in Pillar 1, or even macroprudential measures, if we consider them as a complement of this pillar. This can be seen in the successive efforts to amend Article 501C of the Capital Requirements Regulation. Initially, the text of this provision talks about the need to explore the possibility of a dedicated prudential treatment to exposures that may have a specific link to sustainability aspects, which initially suggested a sort of green supporting factor. Now, the rest of the text of this provision, as it was amended in 2019, then was introduced also the risk dimension. So potentially it was not only the possibility of favoring certain types of exposures, it was also the possibility of assessing the increased risks represented by brown exposures, so to speak. But then as time moved forward, an interesting thing that happened was that the EBA report that was contemplated for 2025 was moved backwards to 2023. So instead of delaying the publication of a report by the EBA to explore these possibilities, the time of the report was anticipated. And in the final version, in the banking package of this provision, instead of one single report exploring the possibility of dedicated prudential treatment, there would be 3 different reports spaced out through 2023, 2024, and 2025. That, in my view, reflects a relatively cautious approach when it comes to incorporating climate-related risks into Pillar 1 measures. And if one looks at the report by the European Banking Authority in 2023, this impression of cautiousness is reinforced. The report is very clear about what the report is not about. So the report tries to emphasize that it is not trying to shift demand of certain types of assets. It has to be risk-based. This is what most of us assumed anyway, because we are talking about Pillar 1 measures, but the fact that it emphasizes it repeatedly shows that it is cautious about sending the wrong signal instead of, let's say, top-down, full-blown assimilation of climate-related risks. So cautious approach to Pillar 1, cautious approach also to macroprudential measures, a reference to the possibility of using macroprudential measures to deal with climate-related risks was introduced initially in a recital. It was subsequently deleted during the legislative process, and it was finally introduced in a recital and in the current version of Article 133. But this is just to exemplify how, hesitant the approach is when it comes to touching the main figures of capital for banking institutions. Now, this sits in contrast with the approach to Pillar 3, where, as we can see, the European Union has been much bolder. The EBA released the implementing technical standards that include very detailed disclosures related to climate-related risks. And even though the approach is nominally risk-based, you can also see elements in the disclosures that go beyond a pure risk-based approach, such as exposures to, let's say, harmful activities, exposures to certain sectors that may be related to transition risks, but it is not a pure disclosure of transition risk. It goes way beyond that. So it's interesting to note the contrast between the very cautious approach in Pillar 1 and the bolder approach in Pillar 3. Now, if we move to Pillar 2 measures, we see that the approach by European authorities is also relatively bolder. The paper released by the EBA, for example, focused extensively on the different methodologies that could be used to address climate-related risks, portfolio alignment, risk-based framework, exposures, performance, and it deals extensively with risk frameworks and specifically with scenario analysis. This is one of the areas where it can be seen that there is a virtuous circle, or at least there is sort of alignment in global efforts and European efforts, to the extent that European authorities try to use the scenarios used by the Network for the Greening of the Financial System as a basis to design their own exercises. Although one can say that the European Central Bank has gone beyond other prudential authorities in designing its climate stress tests or scenario analysis, whichever way we prefer to call them. The section on Pillar 2 points at some of the challenges, even though a lot of development has taken place in this regard. So even though we can see a lot of movement in scenario analysis and other aspects, as well as in the assessment of, for example, governance elements within institutions, the supervisory review and evaluation process is a very detailed and analytical exercise that is conducted by the supervisors. And it involves an assessment of risk levels, which are mostly linked to business strategy and processes, and then risk controls, which are closely linked to governance. Now, not all these elements are equally susceptible to be climate adjusted. To an extent, governance elements can be adjusted. It is possible to assess whether an entity's governance is well adapted to deal with climate-related risks. It is more difficult to quantify the extent to which business strategy and processes have been adjusted to the challenges of climate change. And since in the end, the SREP is supposed to give an aggregate measure that determines the Pillar 2 guidance and potentially Pillar 2 requirements, the difficulty that some of the elements of the assessment can be adjusted to the challenges of climate change and others are more difficult, makes the outcome of this adjustment relatively uncertain. So it is not for lack of will of certain supervisors. The ECB is clearly at the forefront of efforts of adjusting the prudential framework to climate-related risks. It is a matter of the difficulty, technically speaking, of adjusting the exercise. Now, can we make sense of these differences between across pillars and everything? I try to venture some possible explanations or some possible ideas in the last sections. So sometimes just to focus on two aspects that I deal with, I believe that somehow there is a logic of mechanisms that are used to deal with climate-related risk. We can use a logic of exit, where we disclose, we put information out there, and the market takes care of dealing with the risk. This is a logic that is hard to object to. And this is why it tends to be the initial logic, and now the predominant logic when it comes to the assimilation of climate-related risks, because who could oppose more transparency? It is much harder to oppose. Now, when it comes to voice lato sensu, in the sense of adjusting the internal conversation, the governance structures, etc., to climate-related risks, it is possible, but it is a bit more challenging, because it is no longer a binary exercise. Either I invest or divest. I have to calculate requirements. I have to interact with the board. And the case for dealing or not dealing properly with climate-related risk has to be more substantiated. So this is why, even though there is the will in the European Union, especially through the European Central Bank, voice and Pillar 2 measures and the interaction with the supervisor and the governance structure of the entity presents challenges that may explain why the process is taking some time. And finally, we have the penalty dimension or the coercion dimension. So if you don't deal with this, then deal with this or else. Now, this is the most difficult to implement. And I believe that this logic is what explains why Brown penalizing factors, for example, have initially been discarded from the outset. Although it is interesting to note that the main argument against this is the argument of uncertainty. We don't know about this, so we should not impose Brown penalizing factors. But interestingly enough, uncertainty is not an argument against a measure. Is not an argument against a penalizing measure. I'm not saying that it should be adopted. I'm just saying that uncertainty is an argument against a penalizing measure if the risks of the penalty outweigh the risk of doing nothing. And I'm not entirely sure whether this symmetrical assessment has been made. I would tend to think not. And this is what somehow favors a relatively status quo bias in this regard, which from a policy perspective makes perfect sense. You want to achieve a certain level of adherence and acceptance and all that. But again, it is a policy argument or a policy logic. It is not so much a scientific logic, I would say. I think I will stop there just to let Agnieszka the discussion. Sorry.
Thank you very much, David, for your realistic and well-balanced approach in so complex topics. Before I leave the floor to Agnieszka, I ask to the audience if there are any questions. If not, Agnieszka, you have the floor.
Thank you very much for including me in this discussion of this really impressive and hugely needed volume, which brings together a lot of different aspects of the sustainable finance space. I'm also obviously thrilled to be discussing David's chapter, which also aligns closely with my work. So in the comments, I would like to draw a little bit kind of parallels between the research that we've done in this space. And indeed, as David mentioned, this is very much a moving target kind of exercise, which means we are always grappling with the new versions of the regulations, but that's also the fun of it. So I wanted to discuss briefly some of the limitations of the framework that have been discussed, the different trade-offs also, which David's work really interestingly points to in a not so obvious way also. So going very much deeper into the regulatory requirements and thinking about some paths forward, especially on this question of really how to bring meaningful change in the banking sector and in the optimal way balance the different objectives that we have. So on the one hand, the narrowly prudential objectives related to risk related to climate change, but also other aspects of environmental degradation. So what is happening in the space is very much opening of eyes to seeing some of the risks that are out there. They just haven't been properly integrated into the kind of epistemological framework of the banking sector. And but at the same time, we cannot deny that there are promotional aspects to this. So sustainable finance is in parts about industrial policy. It is about socioeconomic transformation and alignment of different policies in different economic spheres. So that's financial regulation is part of it, but it's also what the sustainable finance trend, especially in the banking sector, shows is how intrinsically linked prudential regulation is in this space to sectoral legislation in the real estate sector, in automotive sector, and this is also something that I will come back to. So in the chapter, what David does really expertly is to walk us through the transformation in the different pillars of the banking regulation. So how climate and environmental risks in particular have been integrated into this framework across the three pillars. It also very much aligns some of the observations with align with what we found in our analysis of this framework with Jens van Kloster in an article called The Risky Bet, which also gives you a little bit of a preview of the approach, which are in particular the issues related to inconsistency of definitions of ESG risks across the three pillars. The way that prudential regulation sees ESG risk is also, as David mentioned, quite different among the three pillars. And there is the question of sequencing. So very much we've started with the pillar 3, the disclosure, market-based. This is all about reducing information asymmetries and making investors and other stakeholders see what banks have on their balance sheet. And then very slowly we are moving towards more towards the core of the prudential regulatory regime, namely the carrots and sticks of pillar 2 and the more rigid framework of pillar 1. But we are very much starting from the periphery, let's say, of the capital requirements framework, working our way towards the core. I will come back to this pillar 1 question in a moment. The second point is about how this ESG risk is being perceived. And one thing that also, whilst the speed of opening up of the microprudential regime to climate-related factors in particular is bewildering, what you also see a lot is how different the approaches between the different pillars, but also between the different regulators and standard setters. So when we are at the level of Basel, that has done already over the past few years quite significant advances when it comes to integration of ESG climate change factors only in pillar 2, core principles. In pillar 3, there is a consultation of disclosures. But mostly this focus here is a single financial materiality perspective. When we are in the EU framework, what we see is that even though the regulation refers always to ESG factors, when it comes to how pillar 3 rules are formulated, so the disclosure regime, that the focus there is largely on climate related risks, especially physical and transition risks. The social and governance aspects, even though they exist at the level of regulation and are mentioned, are dealt with in a much more superficial manner. So it's just the qualitative disclosures in that space. Likewise, under pillar 2. So even if a lot of now the regulatory regime is changing, there is more regulatory requirements that are coming. But when we look at the practice of supervisors so far, this is largely focused on climate and sometimes, in some cases, also other broader environmental nature aspects. So we also have this inconsistency still emerging as we are on this very steep learning curve between the perspective which is endorsed by the legislator, by the policymakers, which is ESG-wide, versus the practice of the granular rules developed by the EU regulators, EBA in particular, much focused largely on the E, and likewise for the supervisory practices. So we have this large inconsistency, not to mention the fact that we only are getting an ESG risk definition with the revision of the CRR. So we introduced the whole framework for ESG risk integration into the microprudential framework without a definition. The definition appears for the first time in an annex to the implementing technical standards introducing pillar 3 requirements, and is now subsequently being integrated into the revised CRR that we are all waiting for to be published. So there is definitely a very steep learning curve. Of course, the thought that comes to mind, we all know that the heart is in the right place. We just want to catch up with the risks that are material and that we are facing in the short, medium, and especially the longer term. But this comes at a price of a lot of inconsistencies, tenuous riskification of some of these factors related to ESG in some cases, and problems related to sequencing, which inevitably also give rise to litigation risks. At the same time, it's very important to remember the trade-offs, which David also points to in the chapter, and which relate especially to the risk perspective versus the promotional one. and as well the possible disincentives, which due to the speed of the framework are also inbuilt in the framework. And for example, one that stuck out to me, which I thought is hugely consequential, but also kind of symbolic of the consequentiality of the technical aspects of these rules, are the potential impacts of the green asset ratio disclosures, so the taxonomy alignment on the bank balance sheets, on the financing of transition by small and medium-sized enterprises and climate finance in emerging markets. So because of the data constraints, because of the kind of other aspects of the microprudential framework which are already there, what we are introducing might also have quite a lot of unintended consequences, potentially undermining also the objective of shifting capital flows to finance the transition. And this is something that the lens that we really need when looking at this regulation, how the speed and the shortcomings when it comes to the way that this is being done, how this brings about unintended consequences, potentially undermining the objective of the transformation linked to shifting of flows to Paris-aligned future. So these unintended consequences of regulatory design, which are only accentuated by the fact that different supervisors within the EU have very different approaches and also very different capacities. And clearly when we are in this space, and this is also something that is now is evident in the revised version of the capital requirements package, where supervisors are getting quite a lot of new powers when it comes to both assessing climate-related risks, but also drawing consequences. So as David points out to Article 100, the revised Article 104, which gives the power to supervisors to request changes to improve ESG risk management by banks in short, medium, and long term, is a hugely consequential tool potentially for supervisors. But the ability to use it means that the supervisors need the right capacity to have a very deep understanding of the different feedbacks and dynamics between different aspects of ESG, climate and environmental related factors. And they also need knowledge which is not just financial sector based. It's not just about, and here we are veering into the aspects discussed also by in the previous session related to overall challenges related to ESG, because supervisors cannot only think through the lens of safety and stability, financial stability, they also have to think through the lens of environmental risk. And that's why this opening in the revised capital requirements package, which requires that banking supervisors work with environmental agencies and ministries of finance in the way that they supervise banks from the perspective of ESG, is so consequential, because this is also about integration of this broader world externalities of the banking sector into the lens and what the supervisor sees, which is a huge challenge. And I wanted to finish with a few reflections maybe on the pillar one aspects, which indeed seem to be the strongest tool at the disposal of regulators and policymakers when it comes to integration of especially climate-related factors into microprudential regulation, and just putting a placeholder for some of the regulatory innovations that have been put forward by regulators so far. So on the pillar one aspect, I would actually challenge what David said regarding the what are the limitations on the existing legal framework, what are the limitations that preclude this? So I would actually say that we know where the risks are. We know that fossil fuel companies are the risk, yes, but there is the, let's say, strong inertia and political economy factors which preclude integration. But I think, and as the work on this aspect is stalled, what we see is a lot of regulatory innovation which tries to extend the time horizon of interaction between banks, supervisors, and real economy firms, which are the firms that need to transition. And these are the prudential transition plans, which are included in the revised framework. So the idea that banks have to prepare strategies and integrate in their internal governance aspects related to managing risks related to the transition, so the technological, policy, and behavioral changes. And they have to, in their interaction with clients and in how they report and detail their activities and strategies to the supervisor, they have to present a sufficiently robust approach as to how they will manage this transition risk. And this is a hugely I would say consequential new development. This tool, which the ECB has already indicated numerous times that is bearing particular promise, can be really relevant, not just in terms of the cost of capital, so that's the kind of pillar one aspects, but also in how sustainability and ESG factors become integrated across supervisory processes and also in relationships between banks and clients. And this is here that this microprudential framework, the totality of it, seems to have the biggest potential, which so far is only partly used, but hopefully as we move forward, if we are serious about meeting the challenge of climate change, this is the area where we could see the biggest transformation. Thank you very much.
Thank you very much, Agnieszka. David, probably you need an extra time or an extra session to reply to a lot of comments. Very well welcomed. I ask again to the audience if there are remarks or questions. Yes, there is one.
Hi. Hello, nice to see you again. And so as I'll be the discussant of the next session, I also had the chance to read the paper. Not sure it was really allowed before the book will be printed, but I have a question. So I was very intrigued by the point that David was making about like the bolder approach in Pillar 2 and about like, so a topic that really interests me is the role of scenario analysis. So I was wondering if you could please elaborate on to what extent you think that it is feasible and realistic for regulators and also for the supervisory authorities in the future to provide further guidance on how banks should do scenario analysis, also given the heterogeneous nature that they have and perhaps the different needs of different banks also based on their geographical and sectoral exposures. Thanks.
Thank you very much. I think it depends on whether you ask the question from a scientific standpoint or a policy standpoint. From a scientific standpoint, of course, it is feasible. Of course, I mean, the methodologies are there, the scenarios are there. It is a matter of data gathering. Some central banks like the Central Bank of Brazil, for example, are leading. And you could say, arguably, that initially the prospects about data gathering might have been less promising, and yet there they are. And they are also considering environmental plus social factors. So in terms of the methodologies, etc., I think that the answer is a definitive yes. In terms of the policy implications, that's a different story because the consequence of conducting certain scenario analysis is not entirely clear. They may serve to inform Pillar 2 guidance or even Pillar 2 regulations if there is there are some clear shortcomings evidenced throughout the exercise. And this is where the authorities are being more cautious, so much so that some entities that are conducting these exercises, like the Bank of England or the Federal Reserve, call them exploratory exercises or scenario analysis. They don't want to touch the word climate stress test, which is the one that suggests somehow policy action may follow. The ECB is bolder in this respect. It calls its exercises climate stress test. So again, I think what this illustrates is that the main challenges are policy or political, depending on how you want to look at them. So this is why what Agnieszka said about challenging, what I have said before, it's not real challenge. This is what I actually say. I think that we know that there is uncertainty as to who will suffer the specific harm. We don't know that there is no uncertainty that the risk is there, that the impact is coming. We don't know where it will hit first, but we do know enough to conduct exercises. But conducting exercises when there is some level of uncertainty as to the apportionment of the risk, I would say, is what creates the obstacle to render these exercises actionable from a policy perspective. And this is, I would say, where the main challenge lies.
No further question from the audience. Thank you. Just one.
Thank you very much. Can you hear? Okay, yeah. I have a question about regulatory side. So I work for the private company and the advice to the sustainability strategy. So my colleague, I wonder always that it is very hard work is necessary for putting the information for the rating inquiry from the rating agency. So this is a really big burden. But the more concern is why such kind of outcome are provided. The information disclosure from the rating agency, I think it's not enough. Why such a rating are provided? So I think the company industry have to disclose the information as much as possible, and also the such kind of information providing should be the fair and same level to all stakeholders, including the rating agency and the market. However, rating agencies disclosure, I wonder it's not enough. So how do you regulators think about disclosure policy of rating agency? This is my question. Thank you.
I think we can complement this because this is something that Agnieszka and myself have looked into. The role of intermediaries or ESG gatekeepers is essential in the market because they act as both information aggregators as well as processors or reliable parties that provide an external opinion. So that's the role that rating agencies or ESG rating providers, because we are talking about two different things. Sometimes they may be under the same umbrella, sometimes they are not, but their approach is different. So if we talk about rating agencies, yes, definitely. The adjustment in their methodologies to account for climate-related risk should be clear so that external users of this information can know how reliable it is. If we talk about ESG rating providers, which is a different thing, then the matter is that they fulfill a role that is going to be growing in importance, and the question is how to approach them. The Commission approach is clear. They should be regulated more along the lines of rating agencies, and that requires certain governance rules, organizational rules, and also some disclosure requirements. Arguably, the difficulty lies with the extent to which the rated entities can challenge the ratings. Of course, this is nothing new in the sense that we do know that this is a challenge in the market for regular rating agencies. My initial reaction is the clearer the methodologies are, and the clearer the organizational and conduct rules are, the clearer the pathways to challenge inaccurate or misleading information should be. But at the same time, it is important that the information is somehow out there and it can be used by third parties. Agnieszka, maybe you want to.
No, being mindful also of the time, I think I don't have anything to add. Just maybe on the scenario analysis question that Federica raised, because this is huge. In the context of the transition planning especially, this is a very relevant aspect. How do you integrate forward-looking approaches in transition planning especially? And here there are clearly different, at least a few different types of scenarios that we are talking about, right? So one type of scenarios is thinking about what climate change will do, so NGFS scenarios. Another type of scenarios is the technological transformation and assumptions about decarbonization scenarios in different sectors, which is what banks are using predominantly to assess the alignment of their portfolios with net zero. And then you have kind of scenarios which link to policy change, right? So just specifically focused on the sectoral implications of different regulatory interventions. So, for example, banning of combustion engines or certain assumptions about energy efficiency requirements in buildings, right? So there are lots of, this is a very fertile space for research. So I'm looking forward to the outputs that you will also do in this space, just because there is a lot to disentangle there. And this will be hugely consequential also from the perspective of assessing transition risk exposures and different types of transition risk exposures on banks' balance sheets.
I thank you, all of you, David, Agnieszka, and the audience for joining our second session. We are running 10 minutes late, so we will have a 5 minutes break, and then we reconvene for session 3 on ESG disclosure regulation in 10 to 12. Thanks again for joining us.
Thank you very much, everyone. Have a nice, Bye-bye.
Thank you.
Bye.
Okay, perfect. Thank you, Lynn. We can see your slides. Maybe perfect. Now, I think you went on the presentation mode instead of on the full screen.
Is it better now?
Well, actually, we see the presentation mode with the 2 slides. But
yes. Okay. Let me do it. That's what.
Yeah, this is always tricky.
I had a little issue on my end.
Perfect. Okay. Perfect. Now we can.
Now it's better.
Very good. Thank you. I will just quickly introduce you and your paper in 1 minute, and then I will give you the floor. Okay.
Yes. Perfect.
Perfect. Okay. So welcome back, everyone. Just a few words. So in this session, we will be addressing another topic concerning disclosure once again. And our speaker will be Professor Aline Darbellay, who is professor of law at the University of Zurich. But I think she moved there quite recently from another very prestigious university, the University of Geneva. That's a chapter co-author with Professor Kern Alexander. So just, I would like also only to make 2 points to which maybe the audience can pay attention. Actually, Pierre Schlosser mentioned before this problem that we have with the acronyms when it comes to talking about financial law, particularly in the ESG segment. And actually, this problem is very much referred to show that there are so many standards out there for disclosure, and it's very difficult to cope with them. Just to mention some standards that you can use for the disclosure, you can have the GRI, the SSSB, the IIRC, the CDP, the TCFD, the CDSB, and the EFRAG, finally. These are only some of them. So the question is, how do we deal with all this diversity in the standards? And Aline will drive us through this also by taking a very interesting perspective, I think, meaning one of international law. So who has the jurisdiction, if you like, or the power to decide what standard we should follow? So how do we cope with this complete mess that we have out there? So thank you very much, Aline. The floor is yours.
Thank you very much, Matteo, for this kind of introduction. I will not talk about all the standards now, so I will focus on 2 specific ones, but definitely we will see how to actually try to figure out how to do with the fragmentation of the standards. So thank you very much for the invitation, and I wish I had been able to come to Firenze today, but it's also very nice to be able to present online, and it's also more sustainable, I guess. I'm very delighted that I have contributed to this very impressive handbook on sustainable finance, and I will present the book chapter that actually I co-authored with Professor Kern Alexander, that is on disclosure regulation and sustainability. In my presentation, I will focus on 3 key elements that are developed in the book chapter. First, the shift from soft law to hard law. Second, the concept of materiality. I will focus on the difference between single materiality and double materiality. And third, I will address the importance of cross-border coordination given the fragmentation of the standards and the national rules, and also the extraterritoriality of EU law. First, the shift from soft law to hard law. I'm taking the example of corporate sustainability reporting in the EU. Initially, the talk was all about corporate social responsibility. Basically, it was about essentially soft law and non-binding rules. With the non-financial reporting directive, the NFRD, the approach became more of a hybrid model between actually self-regulation and binding rules. In particular, the comply or explain approach gave the option to management. And this flexibility approach was actually highly criticized because if management has the discretion, the risk is that they would disclose the information that will make the company look good and fail to disclose the information that would be unfavorable to the company. Then with the CSRD, then this problem was actually fixed when the CSRD, the Corporate Sustainability Reporting Directive, was adopted in 2022. And this is a paradigm change to a hard law model with mandatory sustainability disclosure requirements. And I would also like to mention the fact that the CSRD clarified the concept of double materiality. Didn't really introduce it, it was already there in the NFRD, but clarified because it was actually often very misunderstood. And this actually will lead us to the second point of my presentation, the concept of materiality. This is a very central aspect of sustainability disclosure regulation. No matter which are the standards that are followed, materiality will always be the central question. And there are actually 2 different notions of materiality, but traditionally, the materiality test is typically understood as an assessment as to what is the relevant information that has to be provided to investors for them to be able to make an informed investment decision. This is the traditional approach, which is reflected in the single materiality approach. With the single materiality, this looks at this under the financial materiality lens. And this looks at it from the perspective of the primary users of the reports, which are essentially the investors, but also the lenders and other creditors who need actually material information to assess enterprise value. But another concept has gained prominence, and another concept that actually considers two dimensions, the double materiality approach. It considers the financial exposure of the firm to sustainability, which is actually the financial materiality, also called outside-in perspective, to what extent sustainability affects the enterprise value. And it also considers a second dimension, which is the impact materiality, the impact of the firm on society and the environment, also called the inside-out perspective, what impact the firm has on sustainability. The two definitions are possible. In terms of the international standards, the IOSCO has recognized the fact that there are two possible definitions. And there are actually different standards that focus either more on the single materiality approach or on the double materiality approach. And to just give you an example, it's actually the fact that the international standards of the International Sustainability Standards Board, the ISSB, stick to the financial materiality lens, which is it looks at the topic from the perspective of investors as the primary users of the reports. What information do they need to assess enterprise value? But on the other hand, the EU has followed the double materiality approach. The CSRD requires disclosure of both financial exposure of the firm to sustainability as well as the impact of the firm on society and the environment. So what to do when we have different sets of standards? The standards are diverging not only with respect to materiality, but also with respect to other aspects. There are a lot of diverging standards, as Matteo mentioned before. So that leads us to the third aspect of my presentation, which I will cover, is the importance of cross-border coordination in the light of the fragmentation of the standards. There are three models of cross-border disclosure regulation. First, the home country approach mandates the application of the law of the country of origin of the company. Second, under the host country approach, host jurisdictions require the application of their laws to the cross-border activities of foreign entities in host countries. But the problem is, if jurisdictions follow either the home country approach or the host country approach, that this leads to duplicative rules, or this may also lead to conflicting rules. So how to deal with that? There is a third approach that could be the preferred option, which is the equivalence approach. And under the equivalence approach, jurisdictions recognize the equivalence of other rules. Equivalent does not mean that the rules have to be exactly the same, but some level of comparability so that they are found acceptable by other jurisdictions. We argue actually in the book chapter that in the light of the fragmentation of the standards, the equivalence model would be the preferred option and could help to address cross-border issues and eventually lead to global convergence over time. But we are not here yet, actually. And I'm going to give you an example now. Where we are now, it's rather the question of interoperability as an objective. And this is another question. This is not like equivalence, but it's a step before is like interoperability as a question. And I'm going to give you again this example of the CSRD versus the ISSB, the example I took before. So interoperability as an objective, the idea actually, it's to look at the rules, to look at the similarities between the standards or at the differences between the standards, and to see how to do for companies that are actually required to report under both sets of rules. So again, in terms of the difference of the standards, the EU, with the European Financial Reporting Advisory Group, the EFRAG, has developed the European Sustainability Reporting Standards, the ESRS standards, while the IFRS with the ISSB, the International Sustainability Standards Boards, has developed the ISSB standards. They are different, but there are also similarities. And while designing the standards, actually, this is possible to contribute to some level of alignment. And the ESRS, actually the EFRAG with the ESRS and the ISSB for the international standards, they have worked together to try to see where there are differences and where there are similarities. And they have just issued the standards interoperability guidance just now in May 2024. And in this guidance, then we see where actually there are similarities. And one aspect is, I'm going to get back to the question of the materiality that I developed before. The definition of the materiality, actually, although it's different because the ISSB follows the single materiality and the CSRD follows the double materiality, but there is still a high degree of alignment with respect to the definition of financial materiality, because under the single materiality approach of the ISSB, actually this is the question of financial materiality, while under the CSRD with the double materiality, there is two dimensions, and the first dimension, the dimension of financial materiality, is actually very similar to the materiality dimension of the ISSB. So which means that there is quite a degree of alignment, at least in terms of the definition of financial materiality. So practically, as a consequence, for companies that have to report under both sets of standards, they could be able to use similar disclosures for the financial materiality lens, but for the CSRD, they will have to add the second dimension that I mentioned before, the impact materiality, and they will have to add extra disclosures related to the impact materiality with regard to this second dimension of the impact of the firm to society and the environment. So with interoperability, it helps actually to reduce the complexity and the burden for companies that have to report under both sets of standards. When we have duplicative rules, then it's great to have some interoperability, and that actually the standard setters recognize that, so that it reduces the compliance costs and the burden for the companies. As a conclusion, so what I've just developed now, it's first the fact that the EU Sustainability Disclosure Regulation is quite far-reaching. We have seen the shift from soft law to hard law, and then also the clarification of the double materiality perspective. And also, I've just addressed the challenges in cross-border regulation. And in the chapter, what we suggest is that the equivalence approach would be the preferred model in the long run. In the light of the fragmentation of the rules, the equivalence approach could lead over time to regulatory convergence. But as for now, so far, the focus is rather on the interoperability of the frameworks, how to handle reporting under diverging sets of rules. Thank you very much for your attention.
Well, thank you very much, Aline, for the presentation. I think you really managed to be clear in spite of the intricacies of the topic, I have to say. So just to give the floor to Federica Agostini from the EUI. Thank you very much for joining us today, Federica. The floor is yours.
Thank you very much for the invitation and for the honor to comment on this chapter. Actually, when I was invited to this event, I was given the opportunity to choose among the chapters, and I really enjoyed this one. And the reason why I chose it and the reason why I also wanted to bring it to today's discussion is twofold. So first, I really liked the comparative angle, comparative analysis you developed between EU, UK, US, and Swiss initiatives. I think this is really novel and particularly helpful, also taking into account the types of research endeavors that are often discussed in these fora, and also thinking about my own personal experience, we tend to often focus on the EU agenda, which obviously is considered as the forerunner in the sustainable finance arena, but there are definitely increasingly good lessons that could be learned from other parallel approaches.
Sorry, I step in just very quickly. Sorry for interrupting. Maybe, Aline, maybe you can unshare your screen so we will see you. And perfect. Thank you so much. Thank you.
And no problem, and no problem at all. And the second reason is that the topic that is discussed in the paper, so sustainability reporting, is obviously of utmost importance and central in the entire sustainable finance discourse. But the international law lens that you apply is also extremely relevant, especially taking into account that the vast majority of companies operate on a cross-border basis. So thinking about how to regulate their extraterritorial activities is actually crucial for regulators. So yeah, I think that the paper very extensively describes the three approaches that could be used. So this home state approach, this host state approach, and the equivalence approach to cross-border activities. And what I also really liked is that you also link it to the rationale and to the considerations that are linked to these approaches. So investor protection considerations, regulatory arbitrage consideration, competition considerations. So I also very much concur with the conclusion that we need further interoperability among the standards and further convergence. This is also a topic that I had the chance to comprehensively discuss in my doctoral thesis, so I was very much curious and intrigued to read your insightful conclusions about this. And on this point, so I seem to understand from your paper that when you highlight the divergences among the various approaches that have been adopted, you also highlight that the host state approach that underlies the CSRD. So the fact that the non-EU companies that have substantial activities in the EU will also be subject to EU reporting requirements. You seem to argue that this approach could prevent the convergence of international standards. And I was wondering, as I was reading the paper, because you also discuss the role of ISSB standards, whether in the end there are some spontaneous forces that drive towards convergence that actually to some extent outweigh the risks of not achieving convergence just because of these type of approaches. So in my opinion, these other transnational actors still drive towards convergence, and this perhaps may suffice to achieve convergence in the long term. My second point was, as I was reading the paper, because whether it would make, there would be merit perhaps in further work to also expand on the role of CSDDD. So obviously CSDDD is not a reporting initiative, it's more of a conduct initiative, but it also has a similar approach to CSRD in that non-EU companies that have substantial activity in the EU are also subject to the requirements. So there is also a level of and a component of host state approach. So perhaps this may also foster regulatory arbitrage risks, as you highlight with regards to the CSRD, and perhaps this could also be explored in the future. My third point was whether there would be merit in perhaps expanding on some aspects like the role of transition plans, which have fallen under the radar of the regulators across the globe. So actually, because I was curious, I went to read the Swiss federal ordinance that you have described in your paper, and I've seen that it makes reference to transition plans, and I will read it. So it says that the companies should publish transition plans comparable with the Swiss climate goals. That should also include, where possible and appropriate, information in quantitative form, as well as the disclosure of the main baseline assumptions for comparison purpose and the methods and standards used. So I was wondering, so the fact that regulators across the globe are also regulating transition plans, perhaps to various extents, may also be an interesting topic for the future, because if companies are operating on a cross-border basis in countries with different transition targets, this perhaps may also give rise to regulatory arbitrage risks. And lastly, one last point was related to materiality, which has been discussed in your presentation just now, but also in previous papers papers this morning, and this is a concept that is recurrent in throughout these discussions, and we see regulators grappling with this notion and achieving very divergent conclusions. So single materiality, double materiality. So perhaps this is a rhetorical question, but sometimes I wonder whether the notion of materiality is really helpful in the context of sustainability reporting, especially given that even under the CSRD, in my opinion, in the end, it's been also watered down because it's also linked to then a materiality assessment by the company on what the company deems as material. So it has become in practice extremely vague. So I'm wondering if we all understand and are convinced that materiality is the right notion in the context of traditional financial reporting, but is it really the notion that we should use to define what should be disclosed for sustainability purposes and what should not be disclosed? Perhaps this is just a rhetorical question, but in general, I really enjoyed reading your paper. I was very happy to be able to comment it today, and congratulations on your work.
Thank you very much to Federica too for the comments, which touched upon some crucial issues that are, I think, general enough for us maybe to have a discussion also, let's say, open to those that are not so into these topics, let's say. Any general comments or questions? Yes, please.
Thank you very much. Do I stand or sit?
Can you hear from? Can you hear Aline?
Hello, Aline.
Yes, I can hear
yes,
very well.
Great. First, I'll apologize. I'm late for this session. My name is Igazuma, and I'm from Nigeria. I work for Dangote Cement. I happen to be the Chief Sustainability Officer. So I feel very bad that I missed this session because I think this would have been one of the most important sessions for me to listen into as a preparer of sustainability reporting. I'm yet to read the chapter, but from the discussions towards the end, I just wanted to chip in that giving the investor focus of the more regulatory standards now that are coming in and the interest of European private companies in Africa, and also the ISSB's efforts, to get capital markets and to get governments in Africa to adopt the ISSB standards. It's important that when you have the international overview of reporting, the CSRD, the ESRS, and the rest of them, you remember also that that market is transitioning from voluntary to regulatory reporting. So if the companies or startups in Africa are an investment potential, then this needs to be looked at because in Nigeria, for instance, the government has adopted the IFRS standard. I happen to be on the Awareness Readiness Committee. And the feedback we're getting so far from the companies, especially those ones that are not listed on the stock exchange, and the public companies also that perhaps the European investors might want to work with as it has to do with maybe mining or things like that, is that the framework is not, there are too many reliefs that are being requested as far as the development of sustainability reporting is in Africa. The investor lens for Africa is a bit limited, perhaps apart from South Africa. It's important for European investors to understand that in Africa, the social lens, other stakeholders, enterprise value, these are important discussions that the African businesses want to see. That's the value that we want to see from the sustainability reporting. So it's important that you include it, which is why the GRI is still very relevant, though it's voluntary, but businesses are able to see how it ties to value chain, vendors, consumers, customers, employees, and all of that. But the investor focus for the needs and the domestic risks and problems that the African business landscape has right now is a bit limited. And what we do not want is the adoption of box-ticking approaches again, just to meet a regulatory standard, which meets the requirement of investors. So it's important for us to expand this discussion to include Africa, because if Africa is a destination for investment, then you have to look at what value these businesses, derive from the reporting beyond the investor demands. Thank you.
Thank you very much. I don't know, Aline, if you want to follow up on this.
Yes, I'm gonna try to follow up on all the questions I had since the start. So first, and I will go back also, up to the last question. So first, I'm trying to actually summarize what my thoughts based on the comments. So the host state approach versus the equivalence for the EU, actually, what I find interesting is the EU is at the forefront and has kind of a role globally as the leader on the scene. And the question is whether host state approach actually could also lead to convergence. Maybe yes, if everybody follows what the EU does. And the question is to what extent the EU is exporting its law and the sustainable finance agenda, and to how to do it in the most efficient way. And what we argue in the paper, it's actually the equivalence approach that would be interesting. And because actually, if it is possible in the EU, and the CSRD, it's mostly a host state approach, but there is an equivalence mechanism that is possible. And if this is developed by the Commission in a way that is not a political tool, but rather an equivalence based on checking whether the standards are comparable and whether, for instance, the standards are based on international standards, it could be a criteria that could be used to say that this is actually in terms of equivalent, this would be good. Then this could actually, I would say, lead to regulatory convergence and increase also the role also of the EU in terms of actually leading towards global convergence. So I think it's the mix of the host state approach and the equivalence approach that is actually required. Then the other question you had is the CSDD. It would be great actually to expand maybe a further work. You are not the first one that made the comment. We had this comment already before, but actually the chapter is already very long, so we couldn't actually include the CSDD. But definitely this would be great to expand the research and include those aspects. Then you talked about transition plans and you mentioned the Swiss approach. Yes, there is a question of transition plans in the Swiss ordinance. Just I would like to mention the fact the Swiss approach is still comply or explain. So this is a good step to go towards requiring transition plans, but it's still actually in the like kind of a hybrid model between self-regulation and mandatory rule. We are still actually at the stage where the EU was with the NFRD actually in Switzerland with the comply or explain approach. And then you had an aspect related to materiality. Is it the right notion? And I agree with what you said actually. Materiality, the issue is that if we look at it and try to actually make a difference between financial materiality and impact materiality, it looks like it's totally two opposite concepts, while actually the frontier is often blurred and the notions could be overlapping. Sometimes what is actually has an impact when sustainability has an impact on the enterprise, but also actually the enterprise has an impact on the society and the environment, those could be actually more blurred. The frontier is more blurred, and just the concept of materiality itself, the way it is actually used, is kind of challenging and can lead to confusion actually. So I agree with you that this may not be the right notion for sustainability. And finally, with respect to the question related to Africa and the transition from voluntary to hard law and the fact that it's a lot that is requested, whether it's too much that is requested, I would like to say, actually, I understand your point. Definitely, it's a lot to apply all these rules at once, and it would not be good in terms of exercise if it ends up being a check the box exercise just to follow regulatory requirements, but not to actually lead to a real transition. But I would like to say, actually, not only in Africa there is this issue, but many countries in the world where actually it's also transitioning from voluntary to hard law. Even in Switzerland, actually, it's still transitioning from voluntary to hard law. So this is not the only actually place where there is the, like, let's say, the challenge of actually shifting to hard law. And actually, there is still, I think, some room from actually the voluntary standards and just the transition where the comply or explain approach in terms of this hybrid model that helps transitioning from voluntary to hard law. Actually, the comply or explain approach could actually help in this transition.
Thank you very much, Aline, for the follow-up. Any other comments or questions? Please, Leonardo Gianni, thank you.
Thank you very much. Thanks to all of you, and thanks to Alina. My question, I mean, I must say that I'm not, this is not my field of research. So maybe something that you have already explained that I have missed. But my question is still about the equivalence. If I understood well, you think that the equivalence will be the best mechanism to allow for the convergence between the EU and the third countries on this topic. If I remember well, but I mean, again, this is not my field of research, so I'm not sure. In other topics, equivalence was firstly opposed by the European industry because apart from the assessment of the requirements of third countries on the basis of which the Commission will decide whether to grant the equivalence or not, at the end of the day, again, if I remember well, the decision about granting the equivalence to a third country is a unilateral and discretionary decision by the Commission. So basically, the Commission can withdraw at any time the decision. And if I remember well, the European industry was firstly opposed to this in other fields because it was not given legal certainty. Is it something that you ever considered or found also in this field or not?
Yeah, you are right. In other fields like financial services, equivalence, I mean, it's a topic that has been there for a long time and that has not been used very successfully in some fields in the financial services industry. And actually, this is not, as you said, equivalence is a discretionary act, and that was actually criticized then because also post-Brexit, because the fact that it's a tool that can be politicized. So equivalence does not have a good name, I would say, so as you mentioned. But if we trace back actually to a topic that is probably more relevant for corporate sustainability reporting is actually financial reporting itself. And in that topic, the EU had been extremely successful by using actually a method that led to global convergence, and that includes to some extent equivalence, or let's say the substituted compliance that is actually a subset of the equivalence approach. What happened is the EU was extremely successful at actually exporting or making sure that the IFRS framework is used globally. It was a fight kind of between the EU and the US with the US gap. And the US actually lost this fight because actually at the end, even the US themselves had to accept the fact that actually those companies that use the IFRS are actually using standards that are equivalent. They call it substituted compliance, but eventually then even the US actually lost this kind of fight. And actually the EU, and that's the EU that led this global convergence and make sure that everybody actually uses IFRS globally on the global scale, or even if those that don't use actually IFRS would actually accept actually comparable standards, or would actually use their own standards, but would accept actually the fact that IFRS standards are used as comparable standards in other jurisdictions as well.
Yeah, thank you very much.
And this is a reverse, actually, this is a reverse case with the ISSB versus the CSRD, actually. This is not the same case. It's a bit more the reverse story.
Yeah, thank you very much. There is quite a fight among regulatory superpowers behind this kind of dynamics, which makes it. Sorry, if I may close. Perfect, please.
Yeah. Oh, yeah. Thank you very much for your explanation. But I am very much interested in the you explain soft law to hard law. So I think this is the interesting but very sensitive issues. I have related to this. I have two questions. The first one is what kind of condition are necessary for the transforming from soft law to hard law, and also the all law should be transformed from soft law to hard law. I think the soft law, in some case, soft law is fit for the realistic, but I'm not sure. I would like to hear your view, please. Thank you.
Aline, would you like to pick this up? That's a very tricky one. I have to say, I wouldn't be able to answer it. So I'm happy that you are the speaker.
Yes, I don't know, like whether it's gonna be like sufficient answer, but from soft law is important, especially for like international standards are basically soft law, and it's important to have the standards that can be used, and to be able to develop the standards. The first step is very often soft law, and then at some point jurisdictions that actually can adopt binding rules and implement binding rules could use standards and eventually develop them and move them into hard law. So it's kind of a process that has been used a lot in like financial law, generally speaking, and it is also kind of a process that has been like used in the field of sustainability standards, with like developing soft law first, eventually moving it into hard law. And maybe the transitional step is this comply or explain approach that is a hybrid model between self-regulation and binding rules. And then the final step is moving it to hard law. But as actually hard law, it can only be at, at the level of the national states or supranational level for the European Union. So this is kind of the process like going on in terms of adapting standards and then using them into actually national law and adopting them and implementing them then with binding rules at the end.
Thank you very much. We are almost out of time, but I would like to take advantage of my position, because I am very happy that we have actually an expert from Nigeria. If I can maybe close with a more philosophical point, because I have a fear that I would like to share with you so that you let me know what you think about it. My fear is that we might sometime overlook the consequences of what you are doing in the European Union as a regulatory superpower on, let's say, other parts of the world. So just to make it clear, if you look at some benchmarks methodologies or some ESG ratings methodologies, they tend to adjust sometimes for the fact that when they are addressing developing countries, they have to be more lenient maybe on the environmental impact and maybe take more of the societal impact. But I'm not 100% sure that this is really enough. And especially if you consider maybe some of the implications of this directive that Federica mentioned before, this CS3D, as they call it, another alphabet soup. This is a directive which was very recently approved in the European Union, which says, okay, well, as a European company, you cannot just look at what happens in your country, not even in the European Union. You have to bear responsibility to some extent of what is happening along the whole supply chain. So if you have some suppliers from developing countries, then you have to look at what happens there, and you have to report and be liable for that, which is good, I think. Meaning, of course, we have to take on responsibility for instance, child labor somewhere else. My fear is, okay, where do the good intentions stop, and where can you start having an effect that is more of a protectionist nature, maybe favoring some onshoring back of the production? So is this likely to lead to some underinvestments in the developing countries, in your opinion? I mean, do you have any such fear, or you feel like, okay, no, they're doing something good that has some positive implications? So I don't know, just to know about your feeling, if you have any. Thank you.
No, very good and valid question. I think there will be consequences either way. And one of the consequences is that you have nations like China who have lower regulatory risks, capturing those markets. So there will be consequences either way. And we're not saying that the regulations are not a good thing, the accountability and transparency be required of trade partners is not a good thing, but I think there's got to be a mechanism for I would call it a project-based mechanism, not like a phased kind of mechanism that allows, these prospective partners come to the level where, European companies can do business with them on a project basis and perhaps scale up the partnership or scale up the scope as they comply, like just sort of a journey, let it just be a journey, and capacity building, supporting the journey at every level of the way, because the approach of it's got to be this way, these are our values and these are our rules and all of that is actually also exposing the EU to losing out. And of course, we know there's a scramble now, and China will very, very, very easily play in that space. So there will be consequences both ways. And so there's got to be a mechanism that allows for a phased transition to work with these other countries. Yeah.
Thank you very much for this. Okay, if there are no other comments, we are only 3 minutes late, which is great. I think it's never happened in my life. So maybe we can close the seminar here. Well, thank you very much to all the speakers, and just maybe the EUI will make some remarks. Sorry, I missed the last point, but okay, then thank you from the side of the University of Genoa for joining, and yeah, the floor then is to the EUI for some closing remarks. Thank you.
Thank you very much to all of you. So first of all, I'd like to close off with the question. We're discussing the Cambridge Handbook of Sustainable Finance. When is it out, and how can our participants, including those connected online, can get it?
So the forecast is that it should be out in July. I'm not quite sure whether there is a bit of an optimistic, maybe after the summer, let's say. But yeah, on the Cambridge website, you can still see July. So, but yeah, my inside information is that maybe it would take a little bit longer. Yeah.
It's a moving target.
Yeah, I can understand. There's a lot of factors that we're not totally in control here. But thank you very much. So first of all, I wanted to thank our audience here, those of you who took the time today to come here physically, and those of you who are connected online. We had a steady connection online by remote participants, and that was very good to see. And then I also wanted, obviously, to thank very much the editors, so Professor Siri, Professor Gargantini, but also Professor Alexander, who, as you might know, was until very recently a part-time professor at the EUI Florence School of Banking and Finance. So we're really happy to have you suggesting that we host this event at our premises for various reasons. And the most important is obviously that we're very interested in your work, also taking a look at what are the current research and teaching developments that are taking care here at the EUI. So just to provide you a bit with what's the current panorama, we are part of a unit which is called the Florence School of Banking and Finance, and we look mostly at banking and financial matters, and now sustainability and sustainable finance in general is one of our core topics that we're working on. So we had a lot of courses on ESG data and ratings, for example, sustainability disclosures, just another example of green bonds, just to provide examples of the things that we are currently working on as topics, which then obviously translate into concrete executive education training activities. We have a sister school, the Florence School of Regulation, under the EUI umbrella always, which has a unit working on climate regulation. In particular, they look at the ETS market and the EU policies for carbon markets, which obviously can be also other good avenues and other good pools of candidates for reading the book whenever it's out in late summer, let's say. And finally, we are here at the Florence School of Transnational Governance, which, as you can see, it's kindly hosting us here at our own premises in the newest buildings on the EUI campus. And they have a work stream dedicated, again, to climate change policies, and in particular, under the leadership of Professor Joost Delbeke, whom you might already know because he was in charge of developing the ETS at the EU level. And he's also looking at carbon markets internationally. So the examples that we just mentioned Nigeria, China, other parts of the world that were mentioned, especially in this last part. There is a pool of candidates which are indeed interested in your work. So thank you very much for coming here and presenting it. But I see that there's also possible cooperation avenues for the further future. So I hope that this is not a standalone, but it's part of a longer set of events. And having said that, I wanted to wish you all the best of luck for the second presentation day, which I understand that will be remotely and led by the University of Zurich. So that was all from my side. And one final logistical information: as part of your participation today, you're free to join all the sessions this afternoon that will take place over here in the framework of the EUI Climate Week. So hopefully we'll get to see you around here for the rest of the afternoon. Have a nice rest of the day. It was a pleasure having you here.